In this video, I'm going to introduce you to the balance sheet, a financial tool you can use to plan, problem solve and prioritise your business activities, set financial milestones and timelines, monitor your business's financial performance, avoid costly mistakes, and make informed decisions with clarity, direction and peace of mind so you can grow a profitable and rewarding business. Now, just a little disclaimer here before we start. We view the balance sheet a little differently to the traditional accounting view. We take a practical, user-friendly, easy to understand approach so you can quickly take stock of your financial situation. Our view of the balance sheet is not a substitute for a traditional accounting view, rather an alternative, real-world, in-the-trenches view customised for you, the small to medium-sized business owner. Okay, let's get started. Here's an overview of a balance sheet. In this example, we're looking at Sue's massage business. You'll see that Sue has assets and liabilities in her balance sheet. In the balance sheet model we use, an asset is anything in your business that creates income, and a liability is anything in your business that creates an expense. Income minus expenses equals a gross profit or a loss. When there's a profit, the government require a slice of the pie, so gross profit minus tax and levies equals net profit. So let's take a look at Sue's balance sheet in a little more detail. First things first, Sue has some costs for setting up her business. She needs to buy a massage table, furniture, a laptop, a stereo system, towels, oils, and other various items to kit out her clinic. She's also going to have a logo and branding specs designed, a website built so she can sell massage related products, and have some print marketing and signage made up for her clinic. Now Sue has decided to borrow some money from the bank to cover her setup costs. The business loan is added to her balance sheet as a liability, and this creates a regular operating expense of loan repayments. Sue has also decided to lease a small commercial space above a coffee shop in town. The lease contract is added to her balance sheet as a liability, and this creates a regular operating expense of rent. So there's a couple of examples of liabilities creating expenses. On the other side of the balance sheet we have assets creating income. Now this is where our view of the balance sheet differs a little from the traditional accounting view. Remember, we define an asset as anything that brings income into your business. And what brings income into your business? Customers. So as Sue's customer base grows, her asset grows. Her goal is to grow her asset to the point where her income outweighs her expenses and she's left with a big fat juicy profit. Sue's clients who come to her clinic for massage create session income, and her website customers create online sales. So we have assets creating income on one side of the balance sheet, and liabilities creating expenses on the other. Income minus expenses equals a gross profit or a loss. Whoa, easy now Sue, don't go spending all of that profit just yet. This figure is gross. The good folk in Wellington would like a slice of this pie, thank you very much, so they can do lots of useful and constructive things with your tax money and make New Zealand a better place to live. So gross profit minus tax and levies equals net profit. And Sue, net profit is all yours to keep. Okay, so back to our helicopter view to wrap it all up. Assets create income. Liabilities create expenses. Income minus expenses equals a gross profit or loss. When there's a profit, the good folk in Wellington require a slice of the pie, so gross profit minus tax and levies equals net profit. And net profit is all Sue's to keep. She can stuff it under a mattress, bury it in the backyard, or do some more sensible things like pay for her mortgage, living expenses, vehicle, savings, her kids' education, travel. Sue could reinvest some of her net profit back into her business to improve her ability to generate more income and become more profitable, Or she could reduce liabilities by paying off her business loan faster and paying off any other debts she may have. And once she has grown her assets and reduced her liabilities so that she's running a profitable and efficient business, she may even decide to reward herself with the fruits of her labour.